Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement cost with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Today on the podcast, we have Reed Goossens. Reed is an Australian-American real estate entrepreneur, author, and host of the top-rated podcast, Investing in the U.S. After moving to America in 2002, he built RSN Property Group into a national investment firm with nearly $1 billion in multifamily acquisitions. Reed is also the founder of Accounting First Group, a CPA firm rollup transforming the accounting industry. His journey from engineer to full-time investor inspires thousands to pursue financial freedom through smart investing and entrepreneurship. Welcome to the show, Reed.
G'day, Gary. How are you, mate?
All right. Well, Reed and I were going back and forth about the multifamily industry, and we're like, we have to hit record finally and get things going. But I mean, as both operators, we've been taking a beating for the last few years.
Yeah, man. It's been tough. I've got some thoughts around. You've been doing this as long as I have, and but yeah, it's been a bit interesting. And I think we're going. I don't think we are going through a recession right now. Probably at least in the multifamily commercial real estate space. I would dare to say that our tenants also don't feel like the economy is great for the last couple of years. People are not paying rent. It's hard to keep food on the table. We all know inflation has had a massive impact on stuff. So yeah, it definitely doesn't feel rosy. Then on the other side of the coin, investors aren't really, it's a great time to be buying right now because prices have come down 30, 40, 50%. And, I'm seeing pricing from 2017, 2018 pricing, but you're also probably seeing rents from roughly around that time as well. Rents have dropped off a cliff. So it's, there's a lot to unpack in that, but happy to take it in any direction. I think we can be the good, the bad, the ugly, right? On this podcast.
Yeah, I would say like a year ago, if you asked me, and when my crystal ball broke, I thought, NOI would finally be kind of creeping up, occupancy creeping up, cap rates maybe compressing a little bit because we had some rate cuts, and it did the exact opposite, really slapping us in the face a realization of that, kind of extend pretend thing we've all been going through. What are your thoughts on that?
Yeah, look, I'm not an economist, and from what I've heard from people who are smarter than me, so please, I'm just repeating talking heads, and I wasn't around in '08, but '08 was a very hard reset. It was a fundamental structural issue to the banking industry in the US and globally. We've had another similar. Not similar, but another black swan event in COVID that caused a lot of things. And the lessons people have learned from 2008 have dictated what's happening in today's market, and good and bad. So let's talk about the good. The good is that, I've talked to many folks who are in the brokerage world that, like, from the top, but I'm talking federal government level, like, two banks work with your lenders, right? Don't let there be a run on the bank, right? And that stops the run on the bank. That stops hysteria. That stops massive crashes. On the flip side, it creates a really not a V-shaped recovery, but a U-shaped recovery and a long U. And so we've been, in my mind, I think we've been at the bottom for at least 2 years. But I don't see a takeoff yet. And per what you're saying, I was also at the end of 2024, I was like, I think we've turned the corner. I think 2025, and then all of a sudden, boom! It's like rents hit the floor. Well, then they hit the basement. You're like, oh gosh, and then we've got other stuff that is sort of, we can talk about that is affected. But by and large, you can understand why. But it's also having another impact that we're not seeing the sort of the takeoff that we thought we'd be seeing. And talking to some folks again who have been in the industry way longer than I have, are saying this is actually worse than '08 because it's taking so long to get to some smooth sailing, if that makes sense.
Yeah, and the values have gone down, according to, like you said, smarter people than me, than 2008, and regular investors out there don't really fully understand because they're making money in the stock market, gold, Bitcoin, and how is multifamily not producing the returns? And even if your operations are well, because we've improved NOI at some of these properties like 40% in the first year, and yet we're still on some of them, obviously distributions have stopped, and you're just covering your debt, and it's they're getting reports that obviously it's not a rosy situation. Forget where I was going with this, but
well, the other thing you can add to this, and what I also think, you take a sort of step back, like when you think about what you and I have come up with, well, the real pivotal point was the change in the Jobs Act in 2012. Like that changed the way in which investors accessed, diversified investments, right? And you could invest directly with sponsors, yada, yada, yada. It also brought in a lot of big capital that was probably already in the space, but really sort of brought it. I'm talking about institutions, pension funds, people that looked at maybe commercial real estate as alternative and not really like, hey, I don't really advise this, but now it's sort of coming, the whole space became really institutionalized. And then add on top of that, technology, which I think is another big piece of the sort of the 5 or 6 things that have happened in the last 5 years, or at least in the last 10 years. Like I remember back 10 years ago when I'd have to call my comps to see if, what the rent was, right? And you keep on top of that way. And, getting an investor to sign via DocuSign was the coolest thing since sliced bread. Well, now today, the access to data in an industry like commercial real estate, or particularly multi, where it was so archaic in its adoption of technology, that COVID really forced it to go off on a new level, right? Now you've got SaaS companies out the wazoo supporting multi and supporting real estate. Like at a click of a button now, I can see where all my comps are doing, right? That didn't, AI is changing that. And so that's brought down the barrier of entry into it. Add on top of how much money was flooding into it with retail investors, plus the business in a box of going out and hiring a property manager. They look after the day-to-day. We just manage the back end. Like it was all, looking back, it was all a little bit too easy, right? Like, and everyone was making money. And now today where people are getting whacked, pricing was frothy, interest rates went up and values went down, and all of a sudden rents are going the wrong way because of all the supply. So you've got all this, I'm saying a lot of things here, but these are all elements of what has really changed in this space over the last 10 years. And it became, through technology, back to my original point, like ambiguity really shrunk. And so if you don't execute within a razor's edge of, again, before this crash, you can lose your position in the equity stack because you have leverage. So a lot of things have changed. But then now looking at fundamentally where we are today, back to where we're looking at pricing, that was, I'm looking at deals that probably priced, let's call it $80,000 to $120,000 a door, depending on the market. Those were pricing from 6-7 years ago. So you're getting, if you can get the deals done today, and knowing that supply is falling off a cliff and rent growth will return to the market, I think you're poising yourself to be some really fantastic buys. It's just trying to raise the equity, which is the hard part.
Yeah, I agree. It's people will be kicking themselves in a year from now for not buying deals this year, for not investing now, because they're trying to always time the bottom, and you can never time it. You kind of feel where it is, and you've got to make your move, because if you're waiting to the herd, you're too late.
Right. That's right. Yep.
Regardless of taking a punch in the face, we still have to operate and evolve and perform better than we've ever had. What are some of the changes that you've had to do to push through this tough cycle?
Yeah, look, and we just did budgets for 2026, and I can tell you that like it ain't any prettier than 2025. Like we're not seeing a lot of top line revenue growth, at least through the Sun Belt where we are, and we're in Central Texas, Phoenix, we're in Atlanta, we're in North and South Carolina. That's probably across most, we'll call it quote unquote secondary markets. I think in general, it's on the expense side, you've really got to start honing in. We've done a few deals with tax abatements to really just sort of wipe out real estate tax, because that's, in some states it's 25% of the P&L. But for right now, it's like control what you can. So every deal we've done since the end of 2022 has been fixed rate debt. And that's when at least you're controlling one element of the piece of the puzzle. We are seeing some growth in rents in some markets slowly starting to come back. But again, 2024, we thought we hit the floor, but then we hit the basement in 25, and we're starting to see a little bit of an uptick, but it's not pronounced across all of our deals. It's some select deals in select markets. So just trying to really control what we can. Keep the assets full. That's probably the biggest thing we're really focusing on, making sure the back door is closed, getting delinquency down, working with good paying tenants. Don't increase their rents if you've got someone who's a good paying tenant, and just trying to keep good talent as best you can, right? Sort of really battening down the hatches. Again, to your point, I think we've weathered the storm. I think the worst of it's behind us. But there's still, like any storm, there's still a bit of, rain clouds and thunder around that we've got to keep on navigating out towards the, smooth sailing.
Yeah, absolutely. And talk about your kind of investor thesis, because I know you've got some Texas properties, some Phoenix, and then in the Southeast. Where are you going to be investing in the future or on the short term, and why do you like that area?
Yeah, look, I think in general, back to look, I think there's good opportunities. You got to go hunting for them. They're not as prevalent. Like not every deal that's on the market right now is a deal, right? You got to really be careful of two things, which is, have you got a distressed deal and a distressed operator, or do you just have a distressed operator and a good deal that just needs some fixing? We bought a deal in Dallas that had completely equity wipeout a year ago, actually, and but still are going through the absorption challenges. But we're really focused on making sure our basis is the right basis, because if you buy the wrong basis, it can really hurt you, as we've all figured out. But by and large, I still think the growth trajectory is good. I know a lot of people aren't in the call it the value add anymore. I agree, and we're trying to go up the apple tree in terms of vintage, but it's a lot more competitive. Surprisingly more competitive. There's a lot of groups that on a 2000 vintage deal in a well-located area with a good average household income, like there's still 20 offers. You're like, wow, how there's still 20 offers? So I think you got to pick and choose you sort of your battles, and so it's underwriting more. The reason we've spread out to a couple of different markets was we couldn't just be into one market because there wasn't enough deal flow, in 23, 24, 25. So we needed to expand, and then we have. And so we're just looking at more deals. The more deals you turn over, the more likelihood you're going to find a deal. So that means more work for our underwriters, but hey, we know what we're looking at now. We can just quickly churn through them and okay, this is a deal or this is not a deal. So
yeah. And I found that, so you've got like the better stuff, 2000s or newer, and then a lot of the like really old stuff, but there's like nothing in the middle. And that newer stuff has more units. So that means, the price is significantly higher because, it's not 100 units where you can raise for that. It's maybe 150, 200 units. They're building for economies of scale, and getting a big check to close on that is really tough these days.
100%. I think there's a bifurcation of the splitting. I was talking to another sponsor operator, and he was looking at a $80 million deal in out in the valley in Southern California here, and value add 80s vintage deal. And it's like the broker was trying to pull his wool over his eyes, saying they had 10 offers, and it's like, really, you have 10 offers on an $80 million deal on 80s vintage in Southern California? I don't believe you. Like, I just don't. And he was right. There wasn't. And it was just the fact that the broker had promised the seller a certain price and no one was coming anywhere near it. And maybe the two or three offers that were coming in. So you're getting guys at the top end of the market who either can afford to do those deals, and then you're getting everyone else like us at the bottom end of the market. We just tied up a $30 million deal, and we're having sort of looks at ourselves saying, can we even raise money on a $30 million deal today? It doesn't. 2 or 3 years ago, yes, but today it's like the deal size even for us are getting smaller because the money we can raise or can't raise is dictating what we can chase. So
yeah. And finding partners too is hard because for a number of reasons as well.
Yeah, we're just at NMHC like I know you were, and everyone's saying they've got money, except they don't have money for you, So, the tiny box that you want the tick and you present all the things. It's like, oh, right. Well, I don't like X, Y, Z. And you're like, okay, you're on the sidelines still. And I think that's the thing. A lot of people are still on the sidelines, both retail and institutional. And I don't know what triggers it to get back in the pool. I don't, so, yeah.
And obviously everything going on geopolitically doesn't help as well.
No, it doesn't. It doesn't help. And going to war again, and it's just like, okay, here we go again. Like, that's not going to help anyone's confidence in investing right now. So, at some point you got to take a cold hard look at yourself as an operator and say, okay, what are we doing right now? Like, and if we can't raise equity, we really don't have a business. So, okay, what are we going to go do? So I think that's been the realization as a sponsor over the last sort of 2 or 3 years, to say, in good times it's all frothy and good, but in bad times, which is what we're going through, and if you can survive, you'll be just fine. But how do you go and make sure you future-proof the business? And I think that's what we all as sponsors are looking at ourselves, doing right now.
So that's a perfect segue to talk about your CPA firm rollup. Tell me what inspired you and what you're trying to do and all that.
Yeah, so look, a couple of years back in 23, 24, there's just no deals to be had. Like, we were always looking to pick up another stool of the leg, the leg of the stool. And we looked at hard money loans, we looked at pref, we looked at other things. And one of our partners from an earlier deal, sort of KP silent partner, had Australian guy and his wife had moved back to the US after being away for a couple of years. They'd historically been a multi. They'd done some M&A stuff. And they said, look, we moved back to the US because we think there's better multiples when you grow a business here. And he was very bullish on CPA firms. And coincidentally, we had partnered up with a family office out of LA here who had CPA firms as their back. So, had a CPA firm, I should say, as their backing. And we realized, like, that makes a lot of sense. Like, yes, we could go buy the property management company or the GC company, and that could be your ecosystem, or you could go more the financial services side, which is what we've chosen to do. And they actually have more of a crossover than you think. Now, just the roll up in itself is very juicy and a lot of fragmentation, and that is profitable in itself. But there's also hey, we can, there's a crossover there with RSN that maybe that there's inherent investors that want to come over and invest, with us, or obviously all the legal ramifications and the correct way to do it applied. But the thesis is that there could be two very synergistic businesses going on. And look, at the end of the day, we're looking for cash flow. We're looking for, ideally, if we could find it in multi, we would continue to do that. But I remember someone telling me years ago, it's like, if you want cash flow, go buy a business. If you want tax benefits, go invest in real estate. Like, it's kind of true. So we're buying firms. We've bought 2 firms, one in LA, one in New Jersey. We're trying to create a nationwide platform, and we're really focused on firms doing sub $3 million of EBITDA. And think of it like a if you get too small an EBITDA, it's like buying a 12-unit property. It's not really big enough and doesn't have enough scale to have full-time property management. Well, similar with some of these firms, like if you're going too low, you don't have that second layer of management that can continue the operations, because there's not. I don't just go out and I can't get a property management company to manage my CPA firms. We have to do it ourselves. So. But we are seeing a lot of fragmentation. There's just a lot of these older firms that have been in existence for 20, 30 years. One of the firms we bought didn't even have an online payment system. They still accepted checks. Like, it's just, there's so many things that we've learned from the real estate business and managing real estate and getting leases and marketing yourself and all that sort of good stuff that can be applied to another widget and will have outweighted returns versus how much you and I are grinding at the coalface to move sort of inches up the fairway. So that's exciting in itself. We just launched a fund. We're raising $10 to $15 million in equity to go and buy probably about 10 to 12 of these firms. We're buying them at sub 5 multiples on EBITDA going in, and we're going to have an arbitrage up. We think of somewhere between 10 to 14, multiples on a once we hit sort of $10 million in EBITDA and over. So yeah, we just launched, as I said, yesterday, and it's exciting, and gives us another thing to talk about when we're talking to in equity, right? Like, the sort of back to what I was saying before of this institutionalization of the multifamily space and the commercial real estate space in general. I was talking to a family office probably a year ago, and they're like, "Look, you aren't the only person at the bar." You know what I mean? Like, you're not the only. And I'm like, "Yeah, I'm not." Right. And with technology, I can't, we're a good operator and like you're a good operator, but I can't just say, "Oh, I'm better operator than you because I do X, Y, Z difference." Like, that technology that I spoke about before has created that lower barrier. Well, now all of a sudden I want to chat to them about roll-ups and CPAs. Well, I'm the only one talking to them at the bar about that, the bar, so to speak. And so all of a sudden they're like, "Oh, I'm not getting offered that from other people." Like, now I'm interested. I'm interested again. You're like, oh, it's just, you got to just show things a little differently. And again, me as a business owner and keeping the future proofing of our business and RSN and what we do is that sometimes you've got to pivot every now and then. I'm not pivoting away from multi, still going to be what we do. It's just we can maybe be more selective and not have to do deals to keep the lights on. And that's what AFG, Accounting First Group, is all about, and also somewhat synergistic at the same time.
Yeah, I love the idea. I'm excited to see how it progresses, and kind of jealous as well.
Hey man, there's the beauty about it is that, and I'll tell you flat out, like it ain't like there's not just brokers out there. It's not like I just rock up to a town and I go see the biggest broker in CBRE or JLL or Newmark and, "Hey, what deals do you have?" It's even the brokerage side is very fragmented. So when you do find deals, and we've looked at a lot of deals, there's just a lot more juice to squeeze out of it. And that in itself is kind of rewarding, because I'm not competing with 6 other people, 10 other people at the table. I'm competing literally just with myself. And so these closings can take, they don't have to be closed in 90 days and you got to raise $10 million. And it can take a time. And then the structure around it is also interesting. Like, we've got the 2 deals we've got. This is 3 partners at one firm, 3 partners at another firm. All 6 partners rolled over 20% of their sales proceeds as equity into the platform of AFG. They also rolled over a seller carry note. So the structured financing of it is different and more accretive to getting really creative, and keeps people always say, "Well, how do you keep them aligned?" Well, they've got a note on the deal and they've got equity in the platform. They're sticking around, right? Like, they're not sort of, excuse my language, pissing off, or touch wood. But there's different ways you can get creative, which creates a lot of juice just in itself.
Well, nice. Well, Reed, thank you so much, and sharing your expertise on multifamily and your CPA roll-up. Where can listeners find out more about your company and what you're doing?
Yeah, just head over to rsnpropertygroup.com. That's singular, RSN for Nancy, propertygroup.com. You can hit me up on LinkedIn. I'm always on LinkedIn. It's Reed Goossens. And yeah, if you're ever coming through Los Angeles and you want to talk shop, real estate, or CPA roll-ups or whatever, hit me up at reid@rsnpropertygroup.com.
Awesome. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.